Stock bond correlation positive for the first time in a decade. And this is, some really interesting news here and some really interesting price action, especially if this does become the new normal for the I don't know, next couple of weeks, next couple of months, potentially, because we don't normally see this. We don't normally see a stock market that rises and falls with the bond market. You'll remember, just conceptually, think of the treasury bond market as a flight to quality. When the stock market moves lower, people tend to flock to that bond market. When the stock market is doing well, that bond market tends to move lower, and interest rates, which are the inverse of bond prices, tend to move higher. We are not getting that relationship currently, and we'll highlight that in a second. But first, I do want to show you, just because early days of the pandemic were great ones for showing just pretty genuinely historical or theoretical, whatever you want to call it, textbook relationships between stocks and bonds. So much fear enters the market. What the hell is going to happen? Stock market takes a dive. Bond market rises as more demand is there for risk-free assets. When risk is off the table, people are not feeling good. People are selling out of their stocks. They want something that is theoretically risk-free, insured by the U.S. here. And now, since then, we've seen very different dynamics as the correlation between these two markets has gone from pretty far in the red, negative correlation, inverse correlation, to the last handful of months here being positive. And you can see this is data for the last decade. First time that we're into positive territory between the stock market and the treasury bond market is now these two assets are moving in the same direction. And just to highlight further what this means before diving into the ins and outs of this market, remember that bonds and yields move inversely of each other. It's not that, one moves up and the other might move down. It's literally happening at the same time. And so this makes sense, right? To my earlier point, if stocks are doing well, the bond market, there's less demand for that flight to quality. And so for someone to want to buy a treasury bond, they're probably going to demand a higher yield. And so bond prices move lower, bond yields move higher, while stocks are moving higher. And then vice versa, stocks are moving lower, bond prices are moving higher. There's so much more demand for bonds, and so people demand a lower yield. They don't necessarily say, "Hey, I want to flock to this quality and also give me a higher yield." They'll take what they can get when fear is on the table. Now, what we're seeing right now is stock prices kind of inch lower and lower, while bond prices are also inching lower and lower, and interest rates, yields, are moving higher. And you can see, you can almost pinpoint the change in relationship here, and it's going to make sense. Just bear with me for a second. I'm going to land this plane. When you look at the start of 2022, and so much stuff you'll remember happening around the first part of 2022, and then you'll remember that stocks hit their low in the end of 2022. But hang with me here for a second, because you'll see that the correlation turns right around the start of 2022, and up until then, you had, like I say, this normal relationship. Stocks fall on the pandemic, they bounce back and actually make new all-time highs by the end of 2020, and then throughout 2021. And then during that time, the bond market is moving lower. It's not, going crazy. It's not seeing new lows as stocks are seeing new highs, but it's inching lower and lower. And then when this relationship turns, the correlation turns, it's as bonds are actually starting to make new lows for the last several years, and yields are making new highs. And this makes sense because stocks are at that point starting to fear, one, how high is inflation going to get? But more importantly, stocks don't necessarily worry about high inflation. In fact, stocks are usually doing well because they're selling their goods at higher and higher prices. There's so much demand that inflation is rising. What they're worried about is how high can yields get to fight off that high inflation. And so you're seeing this correlation turn at a very relevant time where yields are hitting a new high. Now, taking the bond piece out of it, showing you the inverse, the yield here, you can see that stocks start to roll over as 10-year yields and the yield curve in general is making new highs for the last several years there in the early part of 2022. And this is because at that point, keep in mind, the stock market doesn't like unknowns. It hates, fear in any way when it comes to stocks prices moving up and to the right. And the unknown at this point wasn't a geopolitical risk like we've seen recently. It was, how high are these yields going to go? And then you start to see not only yields moving higher and higher on their own, but stock prices moving lower on that fear and bond prices moving lower as well. So there you have the explanation behind why we are in this, for the first time in a decade, positive correlation between stocks and bonds. Now, what does it mean for the future of the stock market? Well, now I'll show you the highest correlations between stocks and bonds, which will let you know what markets or what parts of the market are most vulnerable to interest rates or yields moving higher and bonds moving lower, but also which markets potentially are the most sensitive and stand to make the most if yields do turn around from these highs. Because we're right back in this same mode right now, and it's a lot of the stock downside that you've seen recently, which is how high are interest rates going to get? We're at these new highs once again, going back to 2007. Is it going to be 5%? If they take a break off 5%, a lot of the sectors and stocks that I'm about to show you would probably take that very well. But if this unknown continues and the next unknown is it 6% or even higher, these are the parts of the market that might not like that so much. Now, from a broad standpoint here, you can see gold actually the strongest correlation of major markets right now that I could find. Positive correlation to treasury bonds, silver right there. And in terms of broad stock indices, the Russell is actually the most correlated to treasury bonds right now, S&P and Dow right behind it. And oddly enough, and this is how dynamic markets are, NASDAQ is the least correlated to bonds right now. Tech stocks, you'll remember at the outset of inflation, and when interest rates were really starting to climb beyond 3%, that was like a real level of like, oh, okay, we don't know how bad this is going to get in terms of high interest rate environment. Those tech stocks were getting hit so hard. Now they're kind of doing their own thing, between the positive earnings that a lot of tech stocks are reporting and everything that's going on. The correlation is not so much there. It's really there in the small caps. And like I say, gold and silver really sensitive to what's going to go on here with treasury bonds and yields. Breaking this apart a little bit to conclude this segment here, I did want to just show some of the sectors, and this might really make sense to you. Real estate, that correlation has really gotten strong between real estate stocks and bonds recently. It was almost like when we were in that 3 to 4% range, and that was really hampering tech stock growth. Real estate was definitely coming off a little bit, but you'll remember that everybody anecdotally was thinking, and also in terms of the market, was pricing in, oh, but rates will go higher to go lower, and then everything will be fine. The real estate market will be unfazed by this, and your mortgages won't be as high, and X, Y, and Z. That's been very different recently, and you can see that in the correlation, positive 0.6 between treasury bonds and real estate, really moving as close to 1-for-1 of any stock sector here, aside from those gold miners, just barely higher. Home builders right behind it, utilities, and then as you would imagine, these interest rates are moving higher to try to bring down some of the prices around consumer staples and consumer discretionary. Also a strong correlation in there. But yeah, there you have it. The first time in a decade that stock and bond correlations are positive. Here are the parts of the economy that are specifically sensitive to yields moving higher, bonds moving lower. we'll see if it's even further losses for real estate home builders, the Russell, or if yields do reverse, if bonds do reverse, could stand to be some of the biggest gainers.